Keith Compton is the co-founder of the Global Public Offering Fund, and Chief Perkins is the CEO of the Perkins Fund Marketing. Gentlemen, welcome. Thank you for being here today. I'm going to start with a warm-up question, because it's such a simple question. How has the pandemic, with all its Zoom constantly, how has that changed the way in which emerging managers are raising assets? Easier, less travel, worse? Who would, I'll start with you. Sure.
First of all, thank you, Marty, for having us. The pandemic has changed, everything, because emerging managers always relied on their ability to meet face-to-face with people and have the opportunity to pitch in front of a live audience. Zoom and Teams and anything else, FaceTime, have certainly tried to replace it, but a lot of people are not, as I said in the last panel, that interested in looking at emerging managers if they can't meet with face-to-face, because a lot of the hedge fund business, at least, has always been personal connection, the ability to analyze somebody when you're in the room with them. And Zoom does not have the ability to even fist bump. The world just has changed. I think that that's one reason that so many established managers that already had relationships with people were able to get more assets over the course of the last 18 to 20 months. Every time you think that pandemic is dreaming, there's a new variant, everybody slows down again. So it's been a very difficult time for emerging managers. I think that you've got to be more open in your initial relationships and more available in your initial calls than ever before. The competition is intense, and you've got to work with people who understand how to deliver your message better than ever before.
Thank you. Thank you, Marty, again for having us. I'm Suzanne Currie, and we are a mini prime broker. So we work with a lot of emerging managers, which we define as typically under $300 million of assets under management. In addition to what Chip has just described, we noticed an enormous amount of seeding capital that was pulled from emerging managers, meaning that managers were ready to launch, they were ready to go, and seeders and allocators said, you know what, we're not terribly sure of what this is all going to mean for COVID, so therefore we're not going to sponsor your launch. And so a lot of managers we had in our pipeline that were ready to launch said, you know what, I'm going to have to sit this one out. We saw it in option strategies, long-short strategies, as well as other alternative strategies. So that would be a dynamic that we experienced as well. What we advise managers is while Zoom calls are very efficient, it's going to lengthen the time that people are going to have expectations for allocations. So we suggested that managers do much more of a monthly, either dial-in call to update prospective allocators on their progress and so on and so forth, or do it even on a quarterly basis, presenting some of their analysts and things of that nature. Great challenge, but it did slow the pipeline down significantly, and particularly for emerging managers that were getting ready to launch during this period of time.
We didn't really introduce ourselves, so I'll just take a second to do that. Chip Perkins, Perkins Fund Marketing. We're a 25-year-old placement agent at 3 p.m. Raised just under $8 billion for people. We're a broker-dealer. Everybody in my organization is licensed. Available on LinkedIn if anybody's interested. Thank you.
Hello, I'm Key Compton, and I'm not 25 years in the making on my current business. I'm actually 3 years in. I am the emerging manager, I guess, on this panel, which I'll quickly hit the question that you asked about COVID impact, because I'm in the middle of building the fund. And the first thing I'll note is that COVID has created some incredible opportunities. I'm a technology investor. I'm an entrepreneur by background, and I think that the item I'll note first is that COVID has really shifted the world. It's accelerated a number of technologies, a number of opportunities. It's also created incredible dislocation. So things take longer, they're more difficult. I've found that I got suddenly thrust into a situation where we had to be more creative about what we did. We had to go deeper on the investment opportunities that we were focusing on. We had to turn, stones in new ways. But at the same time, I think the opportunities that were presenting themselves to us were, in many respects, greater with, higher, opportunity. And so I think it's actually been a challenging but good time for emerging managers. I think it's a really a time to prove yourself, if you will. And at least with regard to our fund, we've been embracing it from that side of the fence. I'd love to snap a finger and have a fundraise done, but I also think it's about uncovering the opportunities and building against that.
Wonderful. Next question. What new trends do you see in due diligence? And anything you'd like to mention, diversity, equity, inclusion, or anything pandemic related, all of a sudden, I don't know, do people wonder about can you travel or can you do this, that? We'll start with you, Suzanne.
Thank you. Yeah, we have seen quite a change, and I tell this to money managers on a daily basis. If you do not have within your presentation an articulated strategy as far as your philanthropy is concerned, your ESG is concerned, and your DEI, meaning diversity, equity, and inclusion, I have seen family offices turn down a perfectly good money manager that is not able to articulate that. And we are advising all emerging managers to be sure within their information packet that they have these types of commentary. Because I've seen a family office that said, we're very philanthropic, and if you're not doing anything that is going to benefit the community, and particularly in COVID, and particularly during social unrest and social injustice, they will not get hired. And I'll show you some big examples. The Ford Foundation, the Levi Strauss Foundation, the Walmart Foundation, they look at emerging managers all the time. And they have said, without a doubt, because they are focused only on social justice issues, as well as DEI and some of the ESG issues, that if a money manager cannot articulate that within their presentation, they're out. And I've seen it happen. So one of the big changes in due diligence is, what are you doing to benefit the greater good and greater community? As a result, we at Celadon came up with a pretty novel concept. We formed our own foundation. And what we do with our money managers is that we take a percentage of their commission and give it to a charity that the money manager has asked us to give it to. So therefore, that money manager can go out into the marketplace and say, we're using a service provider that donates a piece of the commission that you, Mr. Client, are paying to a charity. The other side of our business that's expanded is that we've opened an enormous amount of relationships with charities that are going to their donor base and asking for appreciated stock. And that has caused an enormous amount of interest in how do we get greater donations for charities when the market's at an all-time high. I don't have to tell you people that, in our age cohort of this panel, when we got into the markets, the Dow closed probably about 900 points in a particular year. We just hit 36,000, okay? There's an enormous level of wealth out there, and I think if you're not, as a money manager and an emerging manager, thinking through your philanthropic viewpoint, thinking through your DEA and ESG, you're going to miss out on quite a bit of allocation. But that's a big change that we've seen there, huge change.
I think that Suzanne makes a lot of very good points. I think that ESG, diversity are very important in the market today. But most of the family offices that I ultimately deal with feel it's extremely important to lock performance in, along with all those additional new things that people are looking at. At the end of the day, if I don't mean to be crass, but if I'm up 40 and Suzanne does all those wonderful things and she's up 10, in the
Never
family
gonna happen,
office
by the way.
market, I'm gonna win. But I find that in the, I know it's not their audience today, but in the pension market and foundation endowment market, much more so are they concerned with diversity, ESG, et cetera. If you're in the stay rich business in the family office world, these can be very important things to you. I think that the key thing that you said for family offices is the philanthropy. I think that strikes more of a chord with family offices than does diversity inclusion. Although ESG, I think, is starting to get some good legs as well. But I find that the endowment, foundation, and pension world are more focused on those changes.
So I'm going to hit a different angle, which is the co-invest request. I've one of the trends, and I don't know that I necessarily just bucket this as a due diligence trend, but a very important trend with regard to the investors that we're working with, and more importantly, in discussion with, is that today everyone wants to co-invest. And I think it's not just a, here's my fund, please put it into the blind pool and we'll do what we like with it. There's now a coordinated conversation as to, how are you identifying these opportunities, and then more importantly, how are you sharing them with your LP base, and what is the co-invest opportunity? How do you share your due diligence into those investments? So we've actually, on our side, put a lot more effort into how we think about how we share the investments back to our LPs, and how we create a program that is co-investment rich. And I think that that's a very important trend that is occurring, within the industry, and I think, a shift in allocation as well.
Thank you so much. A quick follow-up question. Do you think that as a portion of the portfolio is going to tend towards ESG, and if Sequoia doesn't, quite jump on that yet, you're not, as an example, right? You're not gonna redeem Sequoia, but if you're adding a new manager, you would want that manager to bring in that ESG into it. Do you see that as potential as a as a dynamic, as people are trying to look at their portfolios and say, is there at least a portion of it in ESG investments? In other words, is this a good angle for new emerging managers as they're trying to get on somebody's a part of the radar and part of allocation?
Just if I need one comment on that, and thanks for the audience member that said I look like Jerry from Succession. I really love the reference. I love the show, and as a matter of fact, my husband happens to be an extra on that show, so we know him very well.
What about Key and I? Where do we fit?
You guys fit in billions, I'm sure. I just want to say that there's there's a huge debate out there as to what, okay, as to what qualifies as an ESG strategy with fairly broad opinions from investor to investor. So I think we still need. Geez, if it's by agent, gee whiz. No, but I do think that there remains a debate, and I'm sure Key and Chip, you would probably agree with that. There's been a lot of, what do they call it, greening, where people say, oh yeah, we're ESG, and they're not in the slightest. They're involved in, ExxonMobil or whatever. So I think there's still debate, and I think we're moving towards a market where this is going to get greater clarity.
Yeah, I just really quickly, I have a manager I met with the other day who said, I don't work in oil and gas, therefore, in my ESG. I'm like, it's a little deeper than that, whatever else you are investing in.
Julie, I have a question for you, for the audience, for the speakers. So you had talked, and maybe you can repeat it when I say it, but we have talked about like short liquidity, but at the same time, you had mentioned Sequoia, who has just opened up a fund that goes on forever, right? And I think that Andreessen Horowitz is very similar. You're seeing more of these kind of like blended venture hedge fund models, where you can have your money in there forever without a shorter horizon for selling. And do you guys have any thoughts on that and in that model? Maybe you can repeat the question, somebody?
Marty's question was, as funds are being launched, and these are blended funds, and they go on, they're basically evergreen funds.
Like Sequoia has just launched an evergreen fund, and Andreessen Horowitz has one too.
Yeah, they're evergreen funds, and what is the panelist's opinion on these types of investments?
Yes.
I think it depends on people's liquidity needs and concerns, and what they're trying to do. If they're, Sequoia's up 100% and you can't get your money, you may not be able to do some of the things that you want to do for your family or for your institution or, philanthropically. So I think that when people are trying to lock this up to ensure management fees forever, the overall terms have to change so that you can get to your money, because we don't know what's happening with the tax structures, but they're starting to think, oh, well, if you've got this accumulated worth in your fund, you got to pay taxes on it. Well, if it's all in the fund, how are you going to pay the taxes? So I think there's more to it than just, oh, I can be with Sequoia forever. Great organization. They've done fabulously well. Who wouldn't want to have an investment with them? But you got to be able to get your money too, unless you're just ridiculously rich.
Right. So it's the exact opposite of what you're doing.
So, well, let me start by saying I think there's to Chip's point, quite a number of trends in the industry. You saw Andreessen Horowitz move to an RIA model. And that preceded the Sequoia Evergreen model. And they're different, but they're part of a broader trend. I think, you're also seeing secondaries take a stronger, play. If I recall correctly, some of the move to the RIA was, related to, structuring of funds and their ability to make certain types of investments. Be it into secondaries, be it into cryptos, be it also the limits that you can run into with regard to how many people you can have inside of a fund structure before you become classified as a mutual fund. So there's all kinds of elements that are shifting the infrastructure, but with regard to the evergreen structure that was recently picked up by Sequoia, that was something that I found quite interesting. I will quickly, note that our GPO fund from the get-go picked an evergreen structure. We did it to accommodate our strategy, which is to invest in companies that are seeking to go public. We look for founder-led companies that are globally scaling, that we believe we can help to move into the public markets more quickly. I like to say, break the state-private forever regime that has dominated for the last, 15 years. And I think with SPACs and with international capital markets adopting and embracing companies at lower market caps, there's quite a lot of interesting opportunity that can accelerate liquidity, and fund structures need to take some of that into advantage, or into their thinking. And that's, I think, a trend that is here. And I think it's going to stay. I think with regard to Sequoia being evergreen, there's going to be, just like with the RIA trend, a number of funds that are going to be, contemplating how do they play in that new framework as we go forward.
And I was just actually listening to a podcast on this, and the commentary actually was from a Sequoia guy, one of the partners who's like, they've made fantastic amounts of money on crypto and Bitcoin and blockchain. And he was like saying, there's some stuff we don't want to sell. And we also don't want to sell companies that we think it's premature to take them public. So his, again, his answer was the exact, opposite of what you would say, which is that, boy, there's a lot of companies that need liquidity, they need access to public markets. Why not take them public somewhere else? There's SPACs, et cetera. But he's like saying, we don't know, we sell no wine before it's time sort of perspective, right?
So to repeat what you just said, there's a trend towards wanting to hold assets longer. And the evergreen structure is accommodating of that. And but I think before we saw the evergreen structure come in, you also were seeing GP-LP agreements shift. It used to be that 180 days after lockup, you distributed the asset. A lot of newer funds or funds that have been refreshed in the last 5 years have actually elongated those hold periods. So there's more discretion at the general partnership level as to how long they hold those funds. So I think that trend has been here for a while. What I like about the evergreen structure is it puts the decision-making back to the LP, right? And we talk all the time about our evergreen structure, and it's different. What we like about it is that we bring money into our fund with an initial 2-year lock. As long as the investment has then gone public and is liquid, our intention is to hold it, for another 3 to 5 years. But if we have an LP that, let's say they're a high net worth individual and they want to buy a home, put a kid through college, they can put in a redemption and we can then accommodate and do it, call it off cycle. And that's very valuable. But at the same time, we have a philosophy where if we're investing in a company with the view of it going public sooner, faster, earlier so that it can grow in the public markets, you don't want to lift your money out of it right away. You actually want to harvest that growth opportunity.
Chip, is this just about management fees forever?
No, I don't think so. I think that he makes a good point that is a reasonable one for investors, which is he's at least recognizing that it's still the investor's money. And that if they need it for something, I always say, death, divorce, family often needs to get their money back, or redistribute it in case of divorce. You need to look at who the manager is and how they feel about, the investors, and the fact that it isn't their money, and it's not just about collecting management fees, but it's about creating wealth for your investors, because that's really what private equity is supposed to do, or venture, or whatever it is. So I think that the hard thing is if you get into these things, it's like getting into a hedge fund that has, lockups and triggers, and gates, and things like that. You've got to read the documents. You've got to understand what it is that you're investing in, and then you've got to weigh the management fee, the performance fee, the liquidity of the opportunity against the overall.
I'm gonna build on Marty's questions and jump to what are some of the strategies that you have seen that are generating interest in the current market? And of course, we've already kind of started talking about that, but anything else you'd like to add? Why don't we, we'll go in the opposite direction.
So the question as to what strategies are generating interest, I'll actually tie this into what we were talking about earlier with ESG. I talked with a lot of other emerging managers. I think that there is an incredible focus on strategies that are ESG oriented. I think there's I'll call it a greening of, the overall investment philosophy. I don't know anyone who doesn't put an ESG filter on how they look at investment opportunities. I think, at the same time, there's a little bit of a difference between, I'll call it a green fund and an ESG filter or viewpoint on a fintech or an enterprise SaaS software, play that you may be trying to make. It's I think, a consideration from my fund's perspective, not necessarily the directive. But you are seeing a lot of funds now where it is the directive. And, I think it's an important shift, and you're seeing it globally. And the other element that I'll touch on is I think there is a global trend, and this goes back to the very first question of, COVID. We live in a world that is more globally interconnected today. I think that we're seeing some fracturing of that. Look at what's happening with regard to China and Diddy unlisting, and there's look at even, the shifts with regard to Hong Kong and voting control. So I think there's some, and even here in the U.S., there's an incredible amount of nationalism that's occurring, and then it's actually undoing a lot of the globalization. At the same time, look at the trends behind crypto and Bitcoin and Ethereum, and you'll see that, with anything that touches the financial markets, we're actually far more global than we ever used to be. So we're living in a really interesting time where I think we are a lot more global than we used to be, but we're also a lot more nationalistic than I think the world was collectively, oriented on, just a few years ago.
Thanks. We're a prime broker, but we also offer cap intro. And so we do a lot of research with family offices as to where their appetites are and so on and so forth. And I just made some notes here in terms of strategy demand increases for 2022. And let me put a finer point on it than Key did. He gave a terrific comment there. But we found clean tech, ESG, and impact. And that went from about under 30% to nearly 40% of interest. The second big long-term trend that we saw versus cyclical trend is cryptocurrencies going from about 21% to about 35%. So that's kind of interesting. In terms of the declining strategies in demand, it really reflects the growing concern over rising interest rates. And so you saw structured credit take a bit of a decline from about 44% to about 32%. Fixed income fell from about 31%, to 31% from 43%. And distressed debt went from about from 51% down to about 38%. And these are based on surveys that have done by Barclays and so on. We can expect negative outflows as interest rates start to creep up, and investors are really looking for those managers that maybe even do, the exception is probably relative value, low net managers who can increase return with volatility in a marketplace. And as credit spreads widen. The greatest demand we're hearing is in long-short equity. And that appears to be quite a change in sentiment regarding the ability of managers to generate alpha versus using ETFs and things of that nature. I had a manager talk to a client about his small cap fund, and he said the reason a lot of small caps stay in an ETF is that they're lousy businesses and they're never going to become anything more than small cap. So I thought that was an interesting point. To round out the group, we're seeing interest in multi-strat, some event-driven, which is defined as merger arb activism, to round out some of these groups. The very good news, I think, for emerging managers is that we're seeing increased appetite in new fund launches. And this would be groups with less than 100 million. So it's interesting to see how many investors are taking the sleeve of capital and allocating that to that smaller manager. And there's a lot of interest in the 1 to 3 year track record as well, which I'm quite surprised at, but nevertheless, the net for family offices we talked to, Marty, is that building the diversified portfolio is still the important factor, with increasing focus on strategies with low correlation to the overall capital markets.
Suzanne?
So, yes, Rob?
I had a question. I think great metrics you're sharing. Whether you or other panelists, are you seeing more families, and I know individuals who are pretty conservative, on the conservative side, wanting your advice on a crypto strategy or allocation?
Well, we don't, we're a broker dealer, we don't deal in crypto, so we really don't touch that space. So, go ahead, Chip and Keith.
Can you repeat the question?
I mean,
Families asking advice on
Oh,
crypto?
Are there families asking us advice on crypto?
Actually, I might maybe have a more encompassing question on that.
Oh,
And so the more encompassing question is, what about the 60-40 model? Because the 40 has not done much for, most people anticipate it's not gonna be doing much for a while, fixed income, right? And
Okay.
people are looking for substitutes. Some people are looking at crypto. There's actually crypto lending that's had big paybacks this year. And any thoughts on the 60-40 model and crypto's place in that?
all right,
And
I'm gonna answer the first question first, and then we'll go to that.
okay,
Because I didn't get my turn. We've looked at, you're looking at ESG, you're looking at diversity, you're looking at all the things we've been talking about. And so if you put that, in a big circle, and then you add to that what I call the C's, clean tech, crypto, carbon, little h, big C for healthcare, and cannabis. These are all areas that people are interested in looking at, but they're looking for non-correlation, they're looking for unique strategies. Long short is having a big comeback if you are an alpha generator, both on the long and the short side. Consistently. And, so that's a big comeback, and I think it goes back to Mark's panel as well. So there's a lot going on in alternatives across the board and a lot of interest. But inside that whole circle, the outside is performance, and performance for the strategy that they're going to invest in. So if you're in crypto and it goes up 50 and down 40 and up 50, you don't want to see that in your long short healthcare fund. You don't want to see that necessarily in any kind of a fixed income alternative. So we're also seeing real assets as a change to fixed income. Somebody's going to be able to give you, I've got a fund that pays out 7% a year on containers, and it's something you can go kick and break your toe on. You get a real asset. It's not going to disappear. So I think that there's a lot of changes in that environment. And back to Marty's question, 60-40, that, I kind of leave that up to the consultants, but the 60-40 model is not probably as prevalent as it once was. People are looking for different ways to get the fixed income side. They don't want negative returns in their fixed income portfolio or 1 or 2%. They're looking for more out of that. And Rob, I don't think I answered your question, but I don't think we don't do crypto right now. We don't give advice. We're not registered investment advisors. So we can present opportunities to people and they have to make their decision where they are.
Okay.
I'll make a quick comment as to the 60-40 ratio. You know, Brian on the prior panel mentioned that there's he has a filter that asks, are you gonna manage my money or make money for me? And I think, you know, the 60-40 ratio is something that's really more suited to how are you managing the money, and, you know, you dial one way or the other. And typically that's for the asset allocators to decide. I think, you know, as an emerging fund, which is what we're here to talk about in this panel, it's more in the, are you there to make me money? Do you have a strategy that's unique and differentiated? You know, assuming you fit inside my asset allocation strategy, why should I be picking your fund over another? When it, you know, comes to, you know, Suzanne, you know, picking, you know, which funds to work with, it's really then a question of, okay, is this going to resonate with the audience? Is the manager going to be, you know, executing the same strategy, you know, 3, 5, 8 years out, or more importantly, adapting their strategy in ways that continue to be in that, are you making me money, as opposed to managing, you know, my assets.
So my only comment is that there's a lot of innovation that's happening in the world in general, and more opportunities for liquidity. I mean, the tokenization of private equity funds, I think, is a big thing. It's going to be bigger. So can you talk about how big the opportunities are for liquidity from what you're doing in terms of your strategy? Because a lot of people don't understand the Australian market, right, or the Canadian market, or UK or SPACs, and can you talk about this relative sizes of how big those markets have been in the last year or two?
So Marty, your question is about the relative sizing of markets and entrance of new strategies, and I just heard you mention, you know, overseas equity markets, SPACs, and tokenization.
So particularly for liquidity for your strategy.
And I think all of those things potentially bring liquidity. I'll also add into that mix that we've seen a real shift in the secondary markets. There's an incredible amount of GP LP secondary liquidity. You've got, you know, Shares Post, Equities Zen, Forge. You've got a number of secondary markets for at least the unicorns. I chuckle when I hear people say, oh, liquidity is not a problem because we've got all these wonderful deep secondary markets. Well, they're deep to the first, you know, 100 unicorns, and then they brutally vanish. So, you know, liquidity is I think, an issue. I don't think just because you tokenize a fund that it magically becomes liquid. I actually think quite the opposite. You can suddenly have a sea of tokenized funds where nobody knows what they are or what the strategy is, and all of a sudden you've got something that plummets in value because there's no marketing around it. It's just like an orphaned stock on an exchange. You know, with regard to liquidity trends, I'm going to, you know, quickly touch on something that's, you know, core to our GPO fund, which is we believe that we now have moved into a market where there's a more global liquidity environment. And, you know, particularly within technology has now disrupted every single industry out there. And with that disruption, you now see the ability for companies that are tech-enabled to enter the public markets in Frankfurt, in London, in Toronto, in Hong Kong, in Singapore, in Australia, in India. So the public markets used to be, I'll call it a lot more native to the home market bias. But today, technology is pervasive, it's global. The real winners become global companies. And I think you're seeing a real shift in opportunities, you know, from how we look at it, to go public anywhere. And I think that that's an important trend. I think crypto and DeFi and, you know, the sort of infrastructure shifts, tokenization will continue to exacerbate that trend. I think SPACs, I'll just quickly touch on them. I mean, we've seen companies in our portfolio that were planning to go public in overseas markets suddenly shift strategy and go public here in the US. And, SPACs have allowed them to basically enter a more prestigious exchange at a lower market cap. Now, there's a trade-off there because we don't have a lot of small cap bridge here in the United States. So on a post-de-SPAC basis, you still have to ask yourself, where am I going to analyst coverage? Are the institutions going to buy my stock? How do I market myself without an IPO event? On the flip side, you just entered, some of the largest and best markets on the globe. So there's a wonderful, new world that we live in. But it's also, I think, going to see a continuous shift over the next, 5 to 10 years. And whether it's, crypto or SPACs or direct listings or overseas listings, I think that mix of environment is going to continue to be around. I think the strategies don't necessarily fundamentally change, right? Are you picking a good investment? Are you picking a good management team? Are they entering into an industry that's still, growing and shifting and changing?
Be great.
When is a fund too small to invest in?
I think I've had people that have come to me and said, I've been trading my own portfolio of $750,000 and got it in a fund format and, I'm killing. That's a little too small. I think that there are people, that will invest in anything, any size, but most of our investors are institutional investors, although they declare that they are ready, willing, and able to invest in emerging managers. People have a different view on what an emerging manager is. A pension fund could be $10 billion in an 8-year track record. For a family, it's usually, because a lot of the families hire fiduciaries to help them with their investments. It's usually, a track record of some sort, a team of some sort. The days of 2 guys on the Bloomberg in a garage are kind of behind us. When I got into this business, we had guys like that, and they became big guys. But it's a long time ago. So we've taken on some people with unique strategies that have $5 to $10 million. It's very unlikely. We usually look for people that have $100 million. But it's considered emerging markets. We'll look, doesn't mean that our investors will necessarily look unless there's something unique.
Yeah, I would say it has a lot to do with the pedigree of the principals. If you've lifted out of Citadel and you've got, 5 million and so on and so forth, you're going to get perhaps a closer look than, as Chip would describe, 2 guys at a card table.
But if you lift it out of Citadel and you only have $5 million, I'm probably not going to
You're
invest
probably
in
not.
it.
Yeah. But no, that's the reality of it. But I think you have to work with not only firms like Chip's and firms like mine that really take an interest on how can we get you in front of the right investor pool that has had the expressed appetite of emerging managers. Meaning that if you're a $4 million long short biotech fund, we want to start to really cover the landscape as to who's out there that really has appetite for that and is not going to let the $4 million be an impediment to them allocating. And we've been successful at that. So, but I do think pedigree is a big part of it. The days of getting $1 billion overnight, I remember Barton Biggs left Morgan Stanley and within 2 seconds he had, $1 billion. That's gone. However, there's a tremendous amount of liquidity out there now. I think I read the other day, what is it, the turn of the century, which sounds bizarre, but it's 22 years ago, for God's sakes. There was $600 billion in the markets. Today, there's 4.3 trillion. And so there's an enormous liquidity that is searching for good ideas, good managers, sustaining strategies. And I agree with Chip that the hardest thing I have found in my career is to find a hedge fund that gets it consistently right on the short side. It's the hardest thing I've decided that ever a manager can
Do
do.
we have a question from the audience? Yeah, one
Yes.
last question, actually, before we're running out of time.
Sure. I know everybody's been talking about funds, but there's a lot in the private arena when there are a couple of smart guys with a lot of good background in technology or specific industry. They start essentially an early stage to acquire or accumulate a few and combine a few entities into one piece. So it would be more of a corporate investment, if you will. Are the cap raisers interested in that as well, or they're just looking for traditional, private equity funds, private debt funds, hedge funds?
Are you talking about so direct investments versus fund?
Yeah, it's essentially, right, you're building out, essentially the management has come together to go either acquire or put together a bunch of entities and they have a business plan. So it's a single investment at the end, with a theme of building or aggregating.
So like a holdco structure, basically?
Yeah, it's
There's a lot of those popping up now more than ever.
For
Yeah.
example, we have a company called NFI, New York Finance, and it has two components that we bought one, we built one, and then now we're in the process, they're not early stage, so, but they're advanced, and there's a whole bunch of acquisition we can make to, really bring them to a different level.
So the
So
question,
if I can rephrase the question, I think the question is, we live in a world today where you're seeing a lot of corporate venture activity, a lot of holdco spin out, restructuring.
Yeah.
And the question is the world of cap inflow and placement agent, interested in those sorts of activities as opposed to, I'll call it the traditional, new and emerging fund management?
You do a really good job of that. There are placement agents that do that and focus more on private opportunities than on funds. And it's not something we do because I don't think that we have the skills necessary to do the due diligence required as a broker dealer on these opportunities, but there are people that do it. We know what we're good at, which is looking at funds. So we don't do it, but other people do it.
And I want to quickly circle back to the prior question about what is too small as a fund. And given that this is a panel about emerging managers, and for everyone that's at this conference looking to either invest in early managers or early managers that are looking to launch a fund, I'm going to say there is nothing that is too small. We live in a world today where we have solo GPs, where we have people that are doing SPV after SPV, we have rolling funds, we have infrastructure like Carta and AngelList that are making the opportunity to become a fund manager literally super, super easy. And I think, for anyone that is looking to become a fund manager, I think the answer is nothing is too small. It's just a question of what's your starting point. Now, as to where do you cross over to cap intro placement agents, there is a threshold. And, whether it's, 50, 100, 250, or $1 billion, it depends on your strategy. And, the advice I give to those solo GPs, those emergent managers is, does your strategy scale? There's absolutely nothing wrong with, doing a string of, 12, 15 SPVs over the next 5 years, and that's your strategy. But if you want to manage a $250 million fund or a $75 million fund, then you need to think about, okay, what does fund 1, fund 2, fund 3 look like as a larger strategy, and how do you bring that to the cap intro placement agency world. And that's where I think there is a too small conversation.
Suzanne, Chip, Keith, thank you so much for sharing your expertise with us today. It's really a pleasure. Thank you.